Welcome to the final session of the St. Louis Regional Freightways Freight Week STL 2023. I'm Mary Lamy, Executive Vice President of Multimodal Enterprises for Bi-State Development, which includes the St. Louis Regional Freightway as one of its enterprises. Yesterday's panel discussion focused on some of the exciting planned developments and manufacturing expansions underway in the St. Louis region, with a focus on why this activity is occurring here and sharing insight to help continue this growth trend. Today, we wrap up Freight Week with a closer look at the 70s corridor, a vital link between Illinois and Missouri. We'll specifically be looking at a 70-mile corridor that includes portions of Interstate 70, 170, 270, and 370, and is the epicenter of the historic surge in new construction and investment in the St. Louis regional industrial market. Before we delve into our final topic, we'd like to thank our sponsors. We appreciate all of the sponsorship support that makes it possible for us to deliver Freight Week STL. This year's presenting sponsors include the Boeing Center, Washington University, Steadfast City, St. Louis, University of Missouri, St. Louis, Millstone Weber, and Ameren. Our supporting sponsors are the Jerry Costello Group and the Hauser Group. Associate sponsors for this year include Southern Illinois Builders Association, Terracon, Albarisi, Castle Contracting, HNTB, CDI, and Brinkman Constructors. Our panel today includes Doug Rasmussen, CEO and Managing Principal with Steadfast City Economic and Community Partners, Ed Lampitt, Vice Chair with Cushman Wakefield, and Matt Hrubes, Senior Vice President with CBRE. Welcome, everyone. We'll start with asking each of you to introduce yourself and your organization, then Doug will lead the discussion. Doug, tell us a little bit more about you and the work Steadfast is doing.
Thank you, Mary. Yes, I'm Doug Rasmussen. I'm the Managing Principal and Founder of Steadfast City Economic and Community Partners. We're a St. Louis-based consulting firm, and we also have operations in Ohio, New York, and Alabama, and in Texas. So we're kind of spread throughout that part of the country. The work that we do is a holistic model around community and economic development. So we spend time working with businesses and real estate developers on economic incentives and site selection, but we also have a urban planning and economic development planning practice and nonprofit practice that works with cities, communities, and other regional EDOs on strategy, on other special initiatives, and on new markets tax credits. So happy to be here and look forward to the conversation.
Thank you, Doug. Turning now to Matt Hrubes, who has been with CBRE St. Louis since January 2021 and focuses on industrial brokerage leasing, tenant representation, and sales. Matt, give our viewers some insight into your background and your organization.
Thanks, Mary. I started in the industry back in 1999 with CTMT, which is now Cushman and Wakefield, and since then it stops at Duke Realty, where I really kind of got into the development role on the industrial side and learned that side of the industry, and was there up until 2020 and joined CBRE in 2021. So kind of mixing the development side in with the brokerage side and focusing on the industrial side of the business, both on the tenant rep and on the landlord agency leasing and sales side.
Thanks, Matt. Next up is Ed Lampitt, Vice Chair with Cushman and Wakefield. Since joining the firm in 2008, Ed has focused strictly on the industrial side of the business and is experienced in everything from land acquisition to investment and owner-occupier sales, with the majority of that experience serving the institutional market. Ed, please introduce yourself and tell us about Cushman & Wakefield.
Well, I didn't start until January of 2020, so Matt Hrubes has been doing this longer than I have. I think it was a couple months, so he is more seasoned than I am. I think that's noteworthy. Cushman & Wakefield's global real estate firm, similar to CB Richard Ellis. Our team, it has a significant St. Louis presence. Our team is strictly industrial focused. I have been here since 2008. It's had 4 or 5 different names, but it's Cushman & Wakefield today. and has been for a little bit. Our team does a considerable amount of leasing along the 70s corridor that we're talking about. But we also do get involved in some capital market stuff here locally, working with capital market teams. One other thing we do, we have some users that take us across the country. So we've got a little bit of a broader perspective in what we're seeing in other markets as well. So yeah, that's our team.
Thank you, Ed. I'm going to turn this over to Doug.
Great. Thank you, Mary. Thanks, Matt. Thanks, Ed. So I was asked to moderate today's session because Steadfast City recently completed some in-depth research on the 70s corridor that we're talking about today. Then again, as a reminder for that, our audience, that includes I-70 and portions of 170, 270, and 370, running from the Wright City, Forestell area to about Highland, Illinois. The St. Louis market, the industrial market itself, has added about 24 million square feet of new industrial space in this region in the last 5 years. And nowhere is this construction boom more evident than in the 70s corridor. It's a major manufacturing and logistics corridor that's home to a wealth of national, local, and regional manufacturers, suppliers, and distributors with room to welcome more. What I like to say as a site selector, it's basically 70 miles of beachfront property. In 2022, there were 8 million square feet of new space delivered, about 6.5 million square feet was absorbed. The top 6 leases in the market in 2022, which represented about 2.4 million square feet, were all signed with companies in this 70s corridor. So you had Procter & Gamble at 2 million square feet, Unilever at 1.7 million square feet, Walgreens with 500,000 square feet, other companies like Tesla and Spectrum Brands. The corridor is home to about 30 occupiers that are more than 500,000 square feet, and there's more than $1 billion of infrastructure improvements along the corridor that are currently funded and with projects either underway or about to begin. So in today's discussion, we're going to explore this corridor in more detail to get insight on what's been driving the growth, how the market is evolving, and what might need to occur for the area to continue to attract new investment, new real estate development, and new businesses. So to start that, Ed, I'm going to turn it over to you for the first question. What trends have you been seeing along the 70s corridor, and what trends do you expect will continue in the 70s corridor?
Sure. Well, we've been calling it the 70s corridor for a while, so I'm going to say you stole that from me. But it's noteworthy. 85% of all institutional product is along that 70s corridor for St. Louis, so it's an appropriate focus. That's where you're seeing most of the bulk of the industrial activity. A couple things I think we're seeing. One of the biggest, especially in 22, was the shift from e-com and 3PL to manufacturing from a leasing activity perspective. Pandemic was an absolute game changer for e-commerce and 3PL, and 70+% of all leasing activity was in those two categories. Last year, the larger deals that you mentioned, a lot of them were manufacturing based companies. So that was one of the main changes we've seen. It wasn't as much manufacturing space. I mean, it was still a lot of distribution space, but still manufacturing based type companies. I think the other thing we've seen, labor is a big hot topic, and finding labor is certainly hard, but I think labor retention is even more important. So when companies are making decisions on where to locate, it's the conversation as much as keeping who you have, as opposed to finding a different location and then being able to go find new labor. And we'll hit that maybe here in a little bit again. I think the other thing we saw and we continue to see is service deliveries continue to go up, meaning they have to be closer to their customers, whether it's e-com, whether it's 3PL. And so we've seen a significant increase of new tenants, new users to St. Louis. We used to quote, 17% of all deals were new to St. Louis, meaning they didn't have a presence here. That's doubled. It's in the 30+% range. So that has led to a lot of this new activity that you just mentioned.
Yeah, absolutely. I saw a stat from your office that said that the manufacturing leases went from 17% in 2020 to almost 60% in 2022, and that e-commerce went from 45% in 2020 to about 1.5% in 2022. So that's a stealth difference. And then
it was shocking to me too. I have to give Matt
Yeah.
Easton credit for that. He's the one that came up with that one. So
yeah,
noteworthy.
Really interesting. And then to your point about sort of the more demand driven and looking at different things, it looks like a lot of the deals I think are, like you were saying, to get to rooftops, get near the labor, all those things. There were smaller deals. It's like, well, about 5 million square feet or so were deals that are under 200,000 square feet. So it's pretty interesting to see that as well. And then, of course, I think one of the other trends, which is seeing some of these larger industrial, build to suit projects, on the 70s corridor, there was this American Foods project in Wright City that was, a huge project, 800 million and 700,000+ square feet. So kind of an interesting 2022 for sure. So thank you for that, Ed. Matt, let's go over to you. How about the same question for you? What have you been seeing along the 70s corridor in some of the work you've been doing? And then what trends do you anticipate will continue in the future?
Yeah, I look at it a little bit through a developer's lens from looking at land sites. And, I think going two things. One, we're very land constraint here because of the levee system and the floodplain issues that we deal with. So there's not a lot of new large tracts of land that are, easily developable sites. You have to either raise it with a significant amount of fill, or you have to find where there's levees already in place, because I don't see any new levees being developed here in the near term. So with that in mind, looking at the 70s corridor, starting where tax abatement originated from in our market over on the Illinois side, I think that trend has continued to make its way into Missouri. And that's what really kind of spearheaded a lot of that development along Highway 70, especially in the Hazelwood market. Looking at what, North Point has done there with Hazelwood Logistics Park, and then also the old Ford plant that Panattoni took down, and they were able to get the tax abatement as well. And without those kind of economic incentives, who knows where we'd be at. But that was really a driving force, I think, that added to the success for those developments and continued to make its way up 370 into the new Hazelwood trade port area that North Point developed. And I think that's a big part of the success there, that they had to raise the ground. They had to basically create a 100-acre lake, create a ground that raised it to the level above the floodplain, along with the infrastructure. And now you have the old Mills Outlet Mall that is being converted into industrial, that has also received 20-year tax abatement. So we're not, over in Illinois was the 10-year sliding scale tax abatement. Over in these areas now you're looking at 18-20 years of tax abatement. That is finally we're able to compete and challenge other states, not just over in Illinois, but if it's a multi-city search, St. Louis now looks a lot better compared to where it used to be, just 5 to 10 years ago. Same thing going across the river over into St. Charles, and you do it in different ways, and their chapter 100s are looked at a little bit differently, but certainly that added to the success for the Premier 370 business park. And without having the ability to get tax abatement there, I think it would have made it even more of a challenge. But you had the demand there, and the perfect storm kind of created this little, this not little, but it's certainly a long-term demand for industrial development, and it was aided much part by all those economic incentives. So, moving along with the labor pool, kind of adding on to what Ed said, that those are the ripe areas for those types of workers. And one of the first things that a lot of these companies do is they need to check the box on the labor study. So if they can see that there's a readily available, whether it's skilled workforce or it's a warehouse workforce, they need to have those things in place before they decide to either lease space or build property in those locations.
Yeah, I think it'll be interesting to watch, you know, let's say the 141 corridor and some of the land that's kind of out in that area. I would agree. I do think the economic development incentive piece is a huge piece with many of these newer parks that are coming on, you know, as you said, doing, you know, 15 to 20 years of tax abatement. And I think it's been interesting. And I think, you know, something that, you know, this region can look to as a site selection advantage. I mean, there are users who, you know, are on a multi-city search who need, not only do they need space, but they need the economics to work, and they may not have, you know, 60, 90, 120 days to figure out whether the local community will be willing to provide, you know, real estate tax abatement. So having that, you know, I think available and already sort of, you know, already blended into you know, the triple net charges and is part of the overall economics of a project, I think just gives a potential tenant and potential employer a lot more certainty when they're evaluating markets. So I would agree, and interesting to hear your discussion about how that sort of emanated from Illinois and went to Missouri. I think that's an interesting conversation. As you see the growth kind of going to the west, I mean, what do you kind of see heading west? I mean, is there like a gateway west compared to like a gateway east at some point, or is that sort of the natural progression, or what are you kind of seeing if you're looking into your crystal ball and industrial development on the 70s corridor going west into Missouri?
Yeah, well, the natural progression's always been from the downtown area out west, readily, you know, more so than anything because there was greenfields out there. Now, if you look at some of those tax abated areas, some, you know, like the Ford plant that was an infill site, Hazelwood Logistics Park was a cleanup site, and really the more greenfield type developments are out west, whether it's, you know, the Hazelwood Trade Port or going into St. Charles. You know, Fountain Lakes was created after Highway 370 was developed, and moving out further was the Premier 370 Business Park. So now you have Lakeside 370 that North Point's developing. There's been some other one-offs there that CRG did with like the Amazon last mile. But I still think that there's going to be a need to continue to grow west simply because I think that's where there's going to be sites that are available to be developed, but also there's a good labor pool over in St. Charles County, and not only in St. Charles County, but once you get to like 7064 and even out towards Forrestal and in those areas, now you can start pulling from Lincoln County, Franklin County, and different areas that are looking for that type of labor. So I still think that there's a tremendous amount of runway that leads you to look further west.
Yeah, for sure. I imagine the case may be the same, probably is the same too, for looking east and Gateway and Lakeview, where some of those parks are. I know from experience talking with some of our clients, they pull in employees from, you know, far away, you know, from the farm and from, you know, Bond and Clinton County and places like that. So it's interesting to see some of these markets and how labor can drive industrial activity. Great. Well, thank you, Matt, for that. So, Ed, I'm going to go back to you on the topic of labor. I'm going to go back to you. You mentioned labor first, so let me go back to you on this. And, you know, it's obviously a key factor, as you mentioned, drawing businesses to the area. And you know, our firm did we've looked at this, you know, on behalf of this 70s corridor initiative. And, you know, it's funny, we actually looked at the types of jobs that are in the 70s corridor, and the number one job is probably not a huge surprise, is a forklift driver. But saying that, there's also, you know, heavy concentration of manufacturing. There's about 12% of industry. It's the second largest industry in this corridor, and that 12% is higher than the region. And then in certain aspects of this corridor, the workforce in manufacturing and warehousing is as high as 22%. So there's a lot of workers that are kind of accessible in this 70s corridor location. And, you know, as you both said, it's a major contributor to, you know, expansion and location in the area. But Ed, what other factors, maybe building off that, what other factors are contributing to companies choosing to expand or locate in this corridor? Is there anything that sticks out?
Yeah, well, a lot of it has been internal growth. I mean, if you look in the Metro East, you can rattle off, I mean, P&G started at 800,000 and now they're at 3 million. Worldwide Technology may be the best, right? We did their first lease with them in 2005 and 200,000 square feet. They're in 3.6 now, right? So big fan of taking care of your own, right? It's always cool to have new companies come in, but I think most of the growth, if you really look into it, has been with companies that are already here and making sure that we take care of them. Absolutely believe that companies make decisions on keeping their current labor. So getting companies to flip from submarket to another is extremely difficult. So with that, you have to have the availability of product within the areas that they already are, right? If you've got to have space available in the areas that they're comfortable in, they've recruited in, and they've maintained their labor in that current area. But I think if you look along the corridor, it's different for each segment. You know, if you start in the Metro East, the success of the Metro East is because it's provided the product that we've seen over the last 15, 20 years, where a 200,000 square foot building was big. And now we've seen 2 million square foot, you know, buildings or deals out in that market, right? And the Metro East was the first park really in St. Louis to be able to provide sites of that size. To Matt's point about trying to develop in floodplains or along rivers, or even in South with the topography issues we have. So
Right.
The availability of product to meet the needs of those big bulk users is what's driven the Metro East. North County is all about local distribution. All of those companies are there because they're serving a very particular network, and they want to be localized within that St. Louis metro area. You know, we call 70 and 270 Main and Main, right? Because that hits the bulk of whether it's other businesses they're serving or rooftops or whatever it is. So North County, that demand is driven by local distribution. And then St. Charles is unique because those folks that are out there, they just love being out there. They don't want to fight traffic. They don't want to come back into St. Louis County. We've done a lot of projects out in St. Charles County, as Matt has, and trying to pull someone from the Metro East or North County, not that it doesn't happen, but most of the time, those users are already located out there because they love the environment. They love to work out there. They love the commute. And so each segment is a little bit different, but certainly have their own advantages.
Yeah, for sure. No, I definitely feel that. I know that it's interesting to think about this market. You mentioned how Illinois was the first real market to sort of have, you know, these larger sites and land and you know, bigger buildings, let's say, and also know that, you know, as this market matures, you know, there's some space in both, you know, in that submarket in particular, but also in other parts of the 70s corridor. I think again, from your colleague, Matt Easton, I saw that he was estimating there might be about 3 million square feet of space that would come back on the market, or, you know, nice sort of second generation space coming back on the market. And you know, maybe Ed and Matt, if you could both, you know, opine on this. I mean, it seems to me like some amount of give back space is healthy, right? I mean, companies need to right size. They need to be flexible. You know, it creates more opportunities for users who may not be able to find space in other markets, right? If you have a building, you know, it's sort of site selection 101 is, you know, you can have the best workforce, the best, you know, quality of life, the best, you know, incentive package, but if you don't have a building that works, you can't locate there. So any thoughts on that in terms of as the market kind of, you know, continues to mature and evaluate, and some of the space that was newer, you know, 10 years ago now comes back on the market?
Yeah, I can go real quick and then Matt, you can jump in, but you have to have, there is a healthy vacancy, right? Especially brokers like us. If there's not space to lease, we don't have as much to do. I'm with Matt. I think if anything, we need to be focusing on making sure there's available land for future development. The spaces that have come back, it's something you're always paying attention to try to figure out why. But even if all of those spaces weren't leased, the vacancy rate is still extremely low over, you know, historical averages. So yeah, it's okay to have some good second generation available space. It's just something we have to watch to and make sure it's not becoming some bigger trend. But I'm with Matt. We need to make sure these developers are finding and developing sites, because these users will also continue to need new product.
Yeah, I agree. I think that it's not the end of the world. I think that looking at Gateway, for example, maybe there's 3 million square feet that's available. A lot of that space, there's still tenants that are really good credit tenants that are paying rent on those spaces. So yeah, it's available, but I also think that you could have, 3-4 deals that absorbs that entire amount of space by the end of the year if we continue the way we have been for the last 10 years. And I don't think we expect it to be the same as the last 10 years, but certainly a big chunk of that could be absorbed yet this year. And I do think that from a development standpoint, though, it does maybe scare some developers to go start a spec building, especially considering where the construction prices are. I know that's certainly something that tenants and anybody that's in capital markets too, that the expense to build these buildings is not going down. It's maybe plateauing, if anything. But I think that there needs to be more spec build right now. There's not enough product out there. To Ed's point about the vacancy rate, it's probably too low. And I think that we need more space, because really kind of you get below that, call it 6 to 8% vacancy rate, it's time to build. And if you don't have it, then you're not going to see the activity. So sometimes you contemplate the what came first, the chicken or the egg scenario, and you need product that's going up in order to lease it. And if it's not there, then you're not going to have leasing. You're not going to have the demand. So without the product, you're certainly at a loss for available space. And I think that we need to continue in that trend, and there's sites available to do that. So hopefully those developers, we get some good economic news here later this year, and they're ready to go.
Yeah, for sure. I remember when we were prepping for this call, one of the examples you both raised was Tesla, who located in St. Louis with a 700,000 square foot facility. And they were initially dialed in, I think, for the Kansas City market, but Kansas City didn't have the product available, didn't have the space. And so it was a true expansion where they went to St. Louis. I think that underlies your point of like, look, part of this is just, if we can make sure that we have a healthy market, healthy product. And again, you're in this 70 miles of beachfront property along a major east-west interstate, that's, frankly, a lot less congested and than maybe some other east-west interstates and whatnot. It's a place that, probably, can work for lots of companies, lots of firms. Okay, well, that's great. So I'm going to move a little bit to, let me just go to the next question. Ed, I'll go to you again. So we've talked here about, what needs to be done. When we think about what needs to be done for this corridor to thrive, a top thing that comes to mind for me is exactly what we're talking about, or at least talking around or talking close to, which is, freight distribution, movement, being in a location where you can get workers in and out, you can get product in and out. The St. Louis market has lots of infrastructure projects planned. FreightWay's latest priority projects list, which is discussed this week in Freight Week. There is about $1 billion in improvement projects funded in this 70s corridor alone. But what else do we need to be thinking of to ensure that the growth continues? I know we've talked a lot about things already, but if you were sort of planning a growth strategy, if the both of you were planning a growth strategy for the regional economic development community, what would you tell them?
I'm not qualified to answer that question, I don't think. I'm just an industrial. We're just industrial guys.
What would
I don't want to be repetitive, but from our world, you got to, think about it. Like if you have a company that comes in and looks in St. Louis and there's these, perceptions, right?
Yeah.
You want to have, I don't care if you're looking for a house or 1,000,000 square feet, you want to have options.
Right.
So if you come into a market and Matt Hrubes is your broker and you say, all right, Matt, show me where everything is. And you're like, you got one option. That doesn't feel good, right? Like you want to have, as a user, you want to have feel like there's a competitive environment.
Right.
And there's a lot of great options out there. So I'm going to beat it to death, but you've got to have product available when folks come to town and stuff to look at. And they get excited when they see a lot of different opportunities and different buildings that they can go look at. If they want to be here and they come in and there's not much to look at, the first thing they do is they go start looking somewhere else. Tesla is exactly right. They were supposed to be in Kansas City. There's a little bit of luck in there too, right?
Sure.
But because Kansas City's building, they're actually building more than we are. But that's a great example. If North Point doesn't have that 700,000 square foot sitting here, they ain't coming. So from our world, that's the best answer I could have, is we've got to have options for users that are coming to town. Did a lot of the infrastructure stuff. You guys can take care of that and answer that better than I can.
Yeah, I agree with what Ed said. I think we both probably get, and especially a user that works with Ed's group a lot, but we get requests that will, hey, it's a multi-city search. Please send us anything that you have it has to be under construction. It can't be proposed.
Right.
What's under construction right now that's over 500,000 feet and will be done by blank date. And
so true. So true.
It's really, it hurts when you can't respond to that because there's nothing going, in St. Louis, we have really, 3-4 developers and, our other competing cities, they have, 20, there's a lot more going on in that regard. And I also think that, things that have helped spur development, before Highway 370 was developed, that land was worthless, it was just farm ground and floodplain. And then all of a sudden 370 comes along. Now look at all the industrial development that's been spurred along there, then comes the Page Extension Bridge. Now look at all the development that's going on along 141 and the improvements that were done there to actually have a connector that goes all the way from South County all the way to North County through, ground zero for our industrial real estate sector, which is Earth City. And you follow 141, there's probably a lot of decision makers that live in that zip code right up the street. It makes sense. So when you add that infrastructure and you invest dollars in it, what it does is it opens up other opportunities for development that makes a lot of sense to a lot of people.
Yeah, for sure. What about, and we'll, maybe one last question for you both here. So what about, some of the trends that are happening globally? I know in some of our clients, we've seen a few of our manufacturing clients, pull in their what normally would have been outsourced to a supplier and vertically integrate production, all in one brand new facility. We've seen this desire to shorten supply chain overall. I think the market is finally, and the statistics are finally bearing out that there's a reshoring trend available as part of that. So, shortening of the supply chain. Are you all seeing that in your work? How is that impacting the industrial real estate market in St. Louis and what you're seeing with your clients?
You want it, Ed?
Sure. Well, I honestly used to ignore all those cool buzzwords and all these global trends and stuff. I think it's real this time around. I think the pandemic taught us a ton. The dependence on China feels like a real thing.
Right.
If we've seen it anywhere, you see these major EV projects that are being announced. I mean, I can't rattle them off, but boy, there seems to be a lot of them. So yeah, I feel like it's real. I mean, the economics still have to work, but I think it's too early to pinpoint that, at least for me, exactly. But I think it's something we should be watching because it sure feels like it's a real thing this time around. I don't know, map.
I'm just thinking of the probably our largest manufacturer in the region is the GM plant. And I look at kind of all the, I'd call it onshoring for that. They built their own or master leased what North Point developed as a supplier warehouse. So I think when you have large scale manufacturing like that, then it does increase the demand for suppliers to that company or that facility, at least, that they all need to locate close to there. Obviously, because of the transportation cost to get those items on demand on time is significant. So yeah, you can call it onshoring, or you can. I think it's been happening here for years, and I think that it'll just continue to ramp up. But certainly, a lot of that's based on manufacturing.
Yep, absolutely. Okay, well, gentlemen, I appreciate your time. This has been a very enriching conversation, and so thank you for sharing your expertise with the audience and with the with me as well. Just to maybe wrap up a few summary comments. So, the 70s corridor is a 70-mile corridor roughly between Wright City, Missouri, and Highland, Illinois, in the St. Louis region. That's along a major east-west interstate. I-70 includes 170, 270, 370, but really handles has a lion's share of the industrial product in the St. Louis market. It's been a rapid growth corridor over the last 5 years. Just in last year alone, a good majority of the 8 million square feet of space was in this corridor. It's a corridor with a healthy amount of product. Product is changing a little bit. There's new developments being built. There's existing buildings coming back on the market, but that's all the sign of a healthy market. And healthy demand seems like it'll continue due to the location's access, due to its location overall, and the ability to get between modes and get to lots of places in the country within a day to 3 days. And also because of the labor market and the rooftops and the access that this corridor provides to the growing areas of St. Louis and to the labor shed and labor market areas of St. Louis. I would say it's also fair to say that this is an evolving market. It's a more diverse market than it was even probably 5 years ago, right? There's more non-local users. I think, Ed, you mentioned, more and more of your clients weren't in St. Louis. It's their first St. Louis location. There's more manufacturing companies, with leasing activity or leasing distribution space to support manufacturing. There's a trend towards smaller to medium-sized clients. So in addition to the big bomber, 500,000 million square foot tenant, as over the last year or so here in particular, there's been lots of smaller clients that are in the 200,000 and below range. So again, I think diverse market, a market that is becoming more contextualized and more diverse through the types of uses, the sizes of uses, and the location along the corridor that those uses support. And I think this is also a healthy build-to-suit market. There's opportunities for industrial users who want to own to build property here. So again, I think great conversation, and we appreciate you sharing your insights, your expertise. I always feel like I learn a lot from you guys, so I really appreciate you coming on. And then Mary, I'll turn it back over to you.
Alrighty, great job, gentlemen. You did fantastic. We appreciate you providing some great insight that will be helpful as the Freightway continues to promote the 70s corridor and its incredible concentration of industrial, warehousing, and distribution operations that make it a prime location for existing businesses and future industrial site selection and economic growth. On our final day, I'd like to thank all of our panelists who teamed up with us to ensure we are delivering the most relevant and timely topics in the logistics industry and providing content of value for the forward thinkers who are shaping the future of the freight industry and recognize FreightWeekSTL as a significant industry event. I'd also like to give a final thank you to our sponsors for FreightWeekSTL 2023. Their support makes it possible for us to continue to deliver the great content that is the hallmark of this annual conference. Thanks for joining us for FreightWeekSTL 2023, and we look forward to seeing you next year.